All right. Hello, everyone, and welcome to this session of Quantopian Book Conversations. It is our great honor and pleasure to welcome our speaker, Professor Marcos López de Prado. Today, he needs no introduction for this community. I'm sure that every single one of you and many more people know him very well. He is also no stranger to Quantopian because he was the keynote speaker in 2018 in the last, if I'm not mistaken, QuantCon conference organized by Quantopian in 2018 in New York City. And it gives me a lot of pain to take even a single second away from all of you talking myself because you didn't come to hear me. But I would like to at least very quickly give an introduction, a little bit talk about Professor de Prado's work. He is a hedge fund manager, entrepreneur, inventor, and professor of practice at Cornell and Khalifa University in the United Arab Emirates. Over the past 25 years, he has helped modernize finance. And if you know the book, you know how his approach has been fundamentally transforming and changing and indeed transcending what exists in that space. I mean, it's kind of a unique work that we are going to talk more about today. He has published many, many papers. He has published 4 books, one of which is the topic of the conversation today. And he had received many rewards and honors. And I will just mention a few of these. Probably the most recent and the most important one is in 2024, just last year, His Majesty King Felipe VI and the government of Spain appointed him Knight Officer of the Royal Order of Civil Merit for distinguished services to science and global investment industry. And currently, he is the global head Quant Research and Development at the Abu Dhabi Investment Authority, who is a founding board member of the ADIA Lab and a research fellow at the same time at Lawrence Berkeley National Lab. Again, if you have gone through the book, you will see all the impressions and all the influence of being in a lab like that reflected in the pages of the book. So I will not talk any more than this. Floor is yours, Marcos, please.
Thank you so much. It's a pleasure to be here. I have very dear memories of my interactions with the Quantopian community. I think that it is a fantastic effort. I'm glad that the effort continues and that the community explores new approaches and continues to evolve. Now, let me give you a little bit of background of how this book and this presentation came about. It was around the year 2016, 2017. At that time, I was managing a large corporate bonds fund, applying quantitative systematic methods. And one of the problems that we had was how do we hire talent that is ready to contribute? One of the issues that we identified was that universities, traditional academic programs did not prepare students for what was really needed to extract alpha from financial markets. And why is that? Academic programs typically focus on problems that may not be relevant in investment management. These are problems that are interesting from a scientific perspective, academic perspective, but perhaps not what really matters when you are managing funds and when you're trying to deliver a return to investors. There are some approaches that have been favored in finance over the past 60 years, some methods, statistical methods that are relatively traditional, or one might even say old-fashioned. Old-fashioned in the sense that these are linear models that are applied on very traditional data sets that have been exploited for decades, and as a result, there is very little alpha left. At the same time, there are alternative data sets that continue to grow and expand continuously. What are the mathematical methods, statistical approaches that are appropriate for those new data sets? Definitely not the traditional ones. These are patterns that are nonlinear, that are very dynamic, that require complex analytical tools to be identified and exploited in a safe and robust way. And that's what we were finding. It was very difficult to recruit individuals who were knowledgeable of these new methods. One possibility would have been to go and hire people with a background, let's say, in computer science or in machine learning. But another issue is that machine learning models that work well, let's say, in face recognition or self-driving cars or detection of objects in images, etc., those models are not necessarily useful in finance. With all of that, what I began to do was to write a manual that would train new recruits, right? That's the origin of the book and this presentation as well. So that's how Advances in Financial Machine Learning came about. That's a book that I wrote in 2017 with the idea that we needed to train our recruits. Essentially, what we did is when we hire someone from university with knowledge in statistics, computer science, economics, etc., this is the manual that we would give that person to study for the first 3-6 months. And once they are ready, then they could contribute to developing our models. And very soon we realized that just like we gave this manual to the new recruits, eventually this manual would come out. So maybe what we should do is to publish this in the format of a book and let people learn these approaches before they join. Now, you might think, well, why would you give your secret recipe or your trade secrets? The book itself is not a trade secret. You can take these models and then still you need to do a lot of work and research in order to extract alpha from a particular data set. So the book is intended as a starting point, and a very good starting point, and that provides a solid foundation for researchers to work on. And it has been a very successful and enriching experience in the sense that very quickly the book became very popular. I think by now we have sold over 100,000 copies, which is quite exceptional in the context of mathematical finance or statistics applies to finance. So it has been a really good experience. And here we are. What I'm going to do today is I'm going to take you through some of the main points, not all of them, of course. After all, I want to give a presentation and then open the floor for questions from the audience. But the idea of today's presentation is to take you through some of the main points of the book. Okay, so let's begin. So what are the key points? Over the past 20 years, we have seen how the financial industry has changed dramatically. At the same time that there are many funds that have modernized and they have applied new statistical methods, we also see a high rate of failure. Some funds become very successful and, in fact, year after year deliver good returns, but you also see that some funds start and after, let's say, 2 years, they have to shut down. And the question is why? Why is it that machine learning methods do not work well for everybody? What makes a machine learning method more appropriate for finance or not? And I describe in the book 7 common errors that people make when they try to develop machine learning models in finance. I don't need to go over this right now because we will see them over the next few minutes. The most important point in this slide is to reach the realization that financial machine learning is not machine learning applied to finance, meaning that I cannot take a model developed by Meta or Google or Netflix and apply it to returns in stock prices and expect that they will do a good job. Machine learning applied to finance is not financial machine learning. Financial machine learning models deal with some very specific circumstances that are present in financial data sets. Financial data sets have some very specific characteristics that mean that the tools that you use to extract insights from those data sets are not generic. They are not the kind of tools that you would use for, let's say, large language models or identifying objects in a photograph, etc. We need to develop a new toolkit that meets the needs and constraints of financial data sets. So you already know about me. I don't need to go over what I've done. I will only mention that I'm in particular interested in the application of financial machine learning for a number of specific problems. Some of the problems that are most interesting to me are data structure, meaning how do you structure data sets from unstructured data? How do you specify the problem that you want to solve? So for instance, corrective AI, meta-labeling. How do you fit those models utilizing, let's say, bugging methods or boosting methods, so ensembling methods in general? How do you combine those signals in a robust way? So that's how I developed the hierarchical risk parity and nested cluster optimization algorithms. How do you apply cross-validation in finance? And how do you avoid backtest overfitting? That's definitely a very important topic when you try to apply machine learning in finance. So what are some of the pitfalls? And again, there are several, quite a few more than I will mention today. The ones I have picked here are the ones that I see most prevalent in the investment industry. So one important pitfall is that the financial industry tends to transform everybody into a generalist. Typically, someone finishes her education and they join a bank or a hedge fund, and very quickly they are put in the direction of becoming a portfolio manager, not realizing that given the level of complexity, competition in the investment industry, the best chance one has to succeed is to specialize in solving one problem very, very well. And what I mentioned in the book is that rather than organizing the work of quants in silos, where every silo is responsible for a particular amount of funds, it makes much more sense to break down the problem of developing investment strategies into 7 problems that I describe in the book and let people specialize in those problems. That allows for a co-specialization that enables solving problems with a level of depth and sophistication that no single individual could do by themselves. So this is what I call Sisyphean quants, right? Sisyphean quant is a quant that is put in a position, typically not by their own choice, but they are put in a position where they must roll this boulder up the mountain, the boulder being the problem of generating alpha consistently, and they're essentially set for failure. My preference is to take a quant, identify what are her skills, strengths, and let that person become really good at something. So for instance, in the context of Quantopian, you have some tools that do some work for you, but there are other areas where you can have tremendous added value. So you want to complement the process, right? Rather than trying to reinvent the wheel and do everything by yourself, identify where you can add most of the value and then focus in becoming really, really good at solving that problem. It could be, as I mentioned earlier, data structuration. It could be in the modeling part. It could be in the theoretical part, like endowing your statistical model with a theory. It could be on the backtesting part or the coding part. It could be in the portfolio construction side or the execution or the underlying technology. It could be in any of these areas, but the important is to identify in what area you are the best and focus in your specialization. So let me go quickly to pitfall number 2. That's integer differentiation. So suppose that you are given a time series of some variable. It could be returns or it could be some other thing. It could be volatility, yields. It could be even observations like number of cars parked in a parking. Now, once you are given this time series, typically in finance, many of these variables are non-stationary. And what does that mean? Well, intuitively, a variable is non-stationary when observations are not comparable with each other. I could give you a mathematical definition, but that's not the point. The point is to recognize the intuition of what a stationarity means. And a stationarity means that observations are not comparable with each other. And if they are not comparable with each other, there is nothing to be learned. The model cannot learn when you present examples that are not comparable, right? Suppose that you give to a model images of where one image is a cat, another one is a dog, another one is a lemon, another one is a tree. What is there to be learned? Nothing is specific of those objects. So something similar happens when you feed a machine learning model with a variable that is non-stationary. Typically, what the model is going to do is it's really going to become a compression model. It's going to overfit, and it's going to translate that information that you are given into some sort of a signature that is very specific to each of the images. So yes, the next time that you present a lemon, the model is going to say, well, this looks like very much like this particular photo that I gave you before. But even if you may change the color of the lemon and you may confuse the algorithm and it may think that it's an apple. So the key idea here is that you need to take these non-stationary variables and apply a transformation that makes them stationary. Now, the way this is typically done in finance and in econometrics is through integer differentiation. What happens when you do integer differentiation? Well, there is a cost associated with achieving this stationarity. And the cost is that you are eliminating a lot of the memory that is present in the variable. So again, I could give you a mathematical definition of memory, but that may not be very intuitive to you. So the way you can think of this is when you are given a time series of prices, you compute returns. Returns are stationary, prices are not, but returns are typically. And what does it mean to compute a return? Well, it's the price of today divided by the price of yesterday minus 1. So this division by the price of yesterday means that you are essentially eliminating level information, right? The level is no longer important. Now you're looking at the return. You have definitely now a stationary series, but if your model is, for instance, a mean reverting model, that level information would have been critical. So now you have a series that is stationary, but without predictive power. That's a problem, right? The whole point of a stationarity was to achieve a series that you can run through a model such that that stationary series retains some predictive power. But the cost of achieving a stationarity cannot be that the variable is no longer predictive, right? So the question is, how do you achieve a stationarity in a way that the variable is still valuable? It still contains valuable information about the future. And so integer differentiation typically destroys a lot of the memory. This is something that you can observe empirically. So for instance, if you take returns of the E-mini S&P, what you will get is that definitely the series passes a unit root test, but at the same time, it has essentially zero correlation to the original price series. The level information is gone. What you can see here in this plot is a price series for the E-mini S&P, and this blue line is the time series of fractionally differentiated returns. So instead of doing an integer differentiation, right, which would give a very noisy series, you can see this blue line that is essentially some sort of mix of returns and levels, right? You can see how there are returns, but at the same time, the blue line still tracks to some extent the green line. You can look at the details of how fractional differentiation is achieved in the book and why it works, but the interesting finding is in this plot. You can see that when you do fractional differentiation, you would be here. You can see my red pointer in the slides, right? You can see that when you do integer differentiation, which means doing differentiation by one lag, the unit root test has a t value of -47 or so, which means it's extremely non-stationary in the sense of a unit root test, an augmented Dickey Fuller test. But at the same time, the correlation of the returns to the original series is almost zero. Instead, you could do a fractional differentiation, and at a degree of something like 0.4, not 1, which would be integer, but 0.4, what you achieve is that, on one hand, the fractionally differentiated series passes a unit root test, but the correlation to the original series is still very high. It's 0.995. Right? The correlation is almost 1. So going back to the previous slide, the blue line can be considered statistically passes a unit root test, but at the same time, it has a correlation of almost 1 to the green series. So that's the idea of fractional differentiation. The idea of fractional differentiation is to find a trade-off between stationarity and memory. And at the right level, it achieves these two objectives of, on one hand, you can utilize this transform variable in a machine learning model, and this transform variable still has predictive power. Okay, now, is this something that is specific of the E-mini S&P? No. You look at the most liquid futures worldwide, and here I have a table of something like, these two tables contain about 80 or so of the most liquid futures worldwide, and not a single future would require differentiation beyond 0.5, right? So the question is, what is everything else, right? If a 0.5 degree of fractional differentiation is enough, why do people apply fractional differentiation of level 1, essentially integer differentiation? It's just mathematical convenience, that's all. But these series are over-differentiated. Now, I can tell you that we could count with the fingers of one hand the number of papers out there, empirical papers, that apply fractional differentiation. Meaning that the vast majority of empirical research in finance utilizes integer differentiation. So it's really, these series are over-differentiated. And as a result, a lot of predictive power is thrown out. And this is an issue with a lot of empirical research, which has led to, for instance, many academics reaching the conclusion that markets operate as quasi-perfect, in a quasi-perfect way. Essentially, one of the claims that academia has made for many decades is that the efficient market hypothesis, essentially, prices incorporate all the available information. And when you think about the implications of what I just told you, one explanation is that if you assess the efficiency of markets in terms of integer differentiation, yes, it appears as if returns contain no predictive power. But the reason is not that prices are perfect. The reason is that the transformation that you have applied to prices has rendered returns without predictive power. So in reality, it's not so much that prices are efficient and markets are perfect, but that many papers are utilizing the wrong transformation to try to understand whether there is some predictive power left. So this would explain why some hedge funds are very successful in violation of the efficient market hypothesis, right? If the efficient market hypothesis is true, there should not be hedge funds that are successful year after year. And one reason is that this transformation, and among other reasons, but this is one of them. So another pitfall is inefficient sampling. There are many papers that look at financial time series, and what they do is they sample applying a time clock. Like, for instance, every day they take an observation, or every hour, or every minute. In reality, this does not make a lot of sense. And why is that? Well, because information does not arrive to the market at a constant rate in time intervals. This is something that high-frequency traders understand very well. Markets exhibit a lot of activity, and prices are very volatile at the beginning, at the end of the session, and also around releases, economic releases or arrival of information. So why would you sample at a regular pace when you know that the information doesn't arrive to the market at the regular pace? You would like to sample in a way that matches the arrival of information, right? So that you can make more informed decisions, right? So that you can add observations to your model that contain additional information, not add observations where the amount of information contained in each observation is variable. So there are a number of ways of doing this. Some ways are more sophisticated than others, but in any case, even the least sophisticated methods will be typically better than applying time bars. So you can apply volume bars, dollar imbalance bars. A dollar imbalance bar, what it means is that you identify when market activity is indicative of the presence of informed traders. And whenever you recognize that informed traders are present and active in the market, that's when you want to sample. And how do you detect if there are informed traders? Well, there are several ways. One of them is by looking at order flow imbalance. If all of a sudden you see that there is a persistent imbalance in the order flow, for instance, many trades are initiated by buyers rather than sellers, this is indicative that someone knows something about the price, right? Typically, in a market that is balanced, nobody is willing to cross the spread systematically and incur in market impact and the cost of crossing the spread itself. So someone would cross the spread systematically only if they know that the immediate cost, the immediate loss of getting the trade done right now is only offset by the prospect that information is not still incorporated into the price. So this is one way of structuring data sets, right? I mentioned that one of the areas of specialization is data structuration. And this is, for instance, one area of research, right? Where you can develop better indicators to recognize when there are informed traders in the market. And there are various approaches for that. One of them is the VPIN theory that David Beasley, Morgan O'Hara, and I developed around the time of the flash crash of 2010. And dollar imbalance bars are part of this VPIN theory. Okay, pitfall number 4 is wrong labeling. What does that mean? Well, many academic studies try to make predictions by labeling the observations in a supervised learning model, where the labels are essentially taking the return, the sign of the return on a given horizon. So very often you find papers in academic journals where what they do is they have some features and then they try to predict the return over, let's say, the next day or the next week or something like that. And it's a fixed horizon. What does that mean? Well, such approach would make sense if you had the limitation that you cannot trade within that week, for instance, or within the horizon that you're trying to predict, right? Essentially, you just want to buy and hold for a week, and there is nothing you can do in between. In that case, yes, that's something that you need to predict. You need to predict. You cannot do any trading in between, and you would like to predict the return after a week, and that's what you would do. But this is really an unrealistic situation. And not only you can trade in between, but sometimes you are forced to trade because you receive a margin call, because the fund that you work for, the risk officer tells you to close the positions because you have, for instance, violated a leverage limit, or you have violated a risk limit or a drawdown or something like that. So what happens in between now on 1 week actually matters a lot. And the idea of triple berry method is let's incorporate that information and let's teach the model that the model needs to learn what happens at any point in time between now and a certain horizon. So for instance, if you are looking for investing a certain amount for up to 1 week, not 1 week exactly, but up to 1 week, but you may be willing to take a profit or a loss at any point in time in between within that interval, then that's what you need to label, right? You need to label whether the price touches any of the barriers that characterize your profit taking or your stop loss, right? And that's what gives you the 3 barriers, right? Triple barrier, because there are 3 barriers. There is the barrier for the profit taking, there is the barrier for the stop loss, and then there is the limit. You are willing to hold that position for a maximum, not for a fixed horizon, but for up to a certain time period. And once you do that, the model is trying to solve the problem that you really need to get solved as an investor, right? Now, there are other forms of labeling, and I'm not going to go over all of them, but the triple barrier method is one way of characterizing the problem that you need to solve in a realistic way. There is another way of labeling called meta-labeling, and meta-labeling, really what it does is, rather than trying to predict a particular outcome, you want to predict whether the predictor is going to make a mistake or is going to succeed. So that's what after I defined this concept, other authors rebranded a corrective AI. And I like the term. I think that actually it makes sense. Meta-labeling, what it means is that you are building a label upon another label. And corrective AI is another way of expressing the same idea. You are trying to develop a machine learning model that corrects whether an underlying machine learning model is making a mistake or not. And it works quite well. Corrective AI, meta-labeling, it's able to succeed by finding a trade-off between precision and recall. Essentially, what it means is that because you're going to ignore a certain proportion of the recommendations of a model, you are giving up recall in exchange for higher precision. And that can be a very good trade-off. Very often, especially for models that produce a large number of predictions, like for instance, every day, what this means is that you can reduce, in exchange for a bit of the recall, you can improve your precision very much. Okay, pitfall number 5 is weighting of non-IID samples. So as I mentioned earlier, not all observations are equally important. Now you can sample your observations in a way that matches the frequency of information arrival to the market, and that's something important. But still, even if you do that, there will be some observations that typically are more correlated with other observations. So this tackles the issue of financial variables typically exhibiting time series dependency. When the observations exhibit some sort of serial correlation, that means that they are not as informative as if they all were independent and identically distributed. So one solution to this is to weight the observations in a way that observations that are deemed less unique receive less of a weight. So what this means is that this, in fact, is something quite specific of finance. Very often, machine learning models, as you can find them in books about deep learning and other approaches, they assume that variables are IID. But this is rarely the case in finance. The identically distributed component is something that you can deal with some of the transformations, as I mentioned earlier, fractional differentiation, but the independent part, it's something that it's quite common in finance, and definitely much more common, this serial correlation issue, than you can find in, for instance, recognizing animals in photographs, like here in the case of a dog, right? Well, you can have many different independent photographs of dogs and train the algorithm to recognize a particular species in that photograph. But that's not the case in finance, right? In finance, typically we receive a single path of realizations where the observations are very serially correlated one to another. So how can we train that algorithm in a way that we are not giving too much weight to some observations over others, and in a way that we make a more efficient use of the observation? And that's what this approach of weighting observations in a way that they reduce the amount of overlap between them and we give more weight to more unique observations. That's something that I explain in the book. I cannot go to the details of all of these things now, but I'm just trying to list to you some important issues that the book addresses and that we all need to think about. So let's go quickly to pitfall number 6. And this deals with a huge issue in finance, and it is, how do we do cross-validation? Very often I find that people utilize k-fold cross-validation in finance, and in reality, k-fold cross-validation typically does not work in finance. And why is that? Well, the reason is, again, that the observations are not IID. This is one big issue. The fact that there is serial correlation means that there is some dependence between observations within some vicinity. And as you do k-fold cross-validation, especially when the number of folds increases, the probability that there is a strong correlation between the test set and the train set, and at least some observations in the train set, is very high. What this means is that essentially the algorithm has been leaked. You are training your algorithm on observations that know something about the test set. The test set is no longer an independent test or a validation test. Typically, algorithms will overfit and they will appear to perform well on the test set, but the reason is that there is leakage. It's not that it has found some generalizable pattern. The problem is that it has identified some very specific observations that are highly correlated with the test set. So how do we avoid that? Well, one way to avoid that is doing what is called purging. When we do purging, essentially we identify what observations on the train set are highly correlated with observations on the test set. And we need to purge those observations from the train set so that the leakage disappears. And remember, it's not that we are breaking the correlation between X and Y. We don't want to do that, right? Precisely. That's what the model is trying to identify, whether it is some sort of association between X and Y. What we're trying to do is we're trying to break the correlation between observations that supposedly are independent from each other. So we are enforcing that the observations behave in the way that the model expects that they behave. So one thing is called purging. Another approach is called embargo. In the case of embargoing, what we do is surgically, we eliminate a certain number of observations that are on the left side at the beginning of folds in the test set, where those folds come after the train set. So essentially, we need to eliminate some observations on the train set that are right after the end of the test set. Okay, so graphically it looks like this. With embargo, you need to remove some observations before and after the test set. So that's for purging. For purging, you need to remove some observations before and after the test set. For embargo, you need to remove some observations right after the test set. Okay, so again, purging on both sides of the test set, embargo right after the test set. You can look at the details in the book. There is also some code for that. And finally, and I will conclude with that, pitfall number 7 is backtest overfitting. So backtest overfitting occurs when the test set is utilized multiple times, right? You, let's say, come up with a model, run a backtest, it doesn't look good, then you go back, change the model, run the backtest, now it looks a little better, change something, and you do that multiple times until eventually you end up with a backtest that looks good. Well, that's not a good approach. If you do that, essentially, you are engaging what is called in statistics multiple testing. And multiple testing means that you can achieve any Sharpe ratio, any p-value that you want just by increasing the number of trials, even if there is no predictive model, no predictive power in the model. There is a way of addressing this, several ways, but one of them is that you want to keep track of the number of independent backtests that you have conducted. So this is the variable k here, and there are statistical ways of estimating the number of independent backtests that you have conducted. And the second one is, what is the variance across the Sharpe ratios that you have estimated? And once you do that, now you know what is the expected value of the maximum Sharpe ratio. Your model needs to beat that value, right? Essentially, now your threshold is no longer, let's say, that the Sharpe ratio needs to be statistically significant greater than 0. Now, as your number of trials has increased, the more trials, the higher is your hurdle, and you need to make sure that the Sharpe ratio that you obtain in your backtest overcomes that threshold. All right, so that's one way to compute what is called the deflated Sharpe ratio. I'm going to stop here because I want to give you time for questions, and we can go over anything that wasn't clear in this presentation.
All right, great. Thank you very much. This was really an excellent presentation of the major points in the book, and I'm really glad that we got to listen to this because we're going to go over this in this course that I mentioned in full details and explore it further. I have a couple of questions that I have received from the audience, and I'm going to maybe combine them in the interest of time with some of the others that I had if they refer to the same theme. So one thing that emerges from lots of questions is that with the recent advances in this area, in general, in the AI and deep learning, has any of these messages about ML, which you addressed about several years ago, change? Or in other words, we could reframe the question as, if you were to write the book now, how different will it be?
Excellent question. I love this question. When you go to the Amazon page for the book, you will find that the majority of readers are satisfied with the book. They find it useful, but there are a few people who wrote comments like, well, this is not really a book about machine learning, right? And their main issue is that in the book, I do not say, oh, you should use this recursive neural network or this convolutional neural network or this particular architecture, right? So some of the criticism of the book is that I did not recommend the specific algorithms. And I hope the readers understood, and I think the majority of the readers understood, that that's precisely on purpose. I did not want to recommend any particular machine learning algorithm because those will change all the time, right? And as you very well said, and our friends here in the call said, this changes month after month, right? Every few months there is a new algorithm out there. What remains are the key problems that we need to solve, right? Data structuration, modeling, so ensemble methods, for instance, labeling. How do you identify a model that is robust? How do you cross-validate the model? How do you backtest? How do you apply machine learning to portfolio construction? So these are fundamental problems. And the techniques that you use to solve each of these problems change. But what does not change is the definition of the problem, right? The definition of the problem is so intrinsic, so essential to investing that remains. So in short, if I were to write the book today, I would write exactly the same thing. I would not change much. I cannot think of anything I would change. Integer differentiation is still a problem. Backtest overfitting is still a problem. Markovich optimization is still a problem. Labeling is still a problem. So these are basic fundamental problems that we all need to solve. And the emergence of transformers or variational autoencoders or any new architecture, that does not change the fact that these fundamental problems remain.
Mm-hmm. Mm-hmm. Yeah. Well said. Well said. Yeah, these are, I guess, problems that are model or tool agnostic in some sense.
Mhm.
They transcend
Yeah,
no matter what you do, even if in 5 years' time from now somebody comes up with this miraculous way of doing things that we have never seen before, still they need to use the data and they need to label the data. And some of the basic things, they need to do. The car still needs to have the wheels. Like
yeah.
the problem with the wheel, no matter how fancy the car you have, you still have to run it on the wheels, on the tires. So, and things like that. So, yeah. So here is another question that you actually made a reference to cross-validation a while back and in your comment now. And the question says you advocated combinatorial purged cross-validation method for backtesting, which has very attractive properties. But does this method have the same stationarity versus memory dilemma in that the combinatorial approach assumes some kind of time invariance?
Great question. The idea of combinatorial cross-validation is that cross-validation will give you a single path. Cross-validation done within a typical approach like K-fold, there are others, but typically what it happens is that every observation is used once and only once for the test set. And as a result, there is a single path that you obtain. Whenever you are optimizing for a single path, that's something that is very easy to optimize, right? You are very unhappy with a return in February of 2013, and you will modify your model so that that return is now looking better, right? So it's very easy to overfit a single path in a backtest. However, it is very hard to overfit a million paths, right? Because some paths will do better, and as you fix some other paths, you make other paths worse, right? So as you increase the number of paths, it becomes very hard to overfit your model. Not impossible, nothing is impossible, of course, but it introduces a regularization that otherwise would be missing. So that's the basic idea of combinatorial cross-validation. How can we generate these many paths such that it becomes incredibly hard to overfit? And one very nice aspect of combinatorial cross-validation is that not only it gives you a method that is resilient to backtest overfitting, it also gives you the entire distribution of the Sharpe ratio. Right? So that now it's not that you're going to pick the best backtest, the backtest with the highest Sharpe ratio, but you can compute a median, right? So now that you have a medium Sharpe, it's much harder to overfit, right? Of course, there will be some right tail Sharpes that are incredibly high, but the median gives you a much more humble and realistic measurement of how the model generalizes. So that's the basic idea. Now, you also made mention of how is this connected with time series being non-stationary. So when you look at the book, I mentioned combinatorial purge cross-validation. So yes, you want to eliminate this leakage that occurs in cross-validation. In K-fold cross-validation, there is a high potential of leakage whenever the variables exhibit serial correlation. And the idea of combinatorial purge cross-validation is as you break down the observations into these folds, you need to purge certain observations from your train set to avoid this leakage. So in the book, I explain it, and the key concept to keep in mind here is that CPCV, combinatorial purge cross-validation, solves two problems at once. Number one problem that it solves is the risk of overfitting. The second problem is that we need to deal with serially correlated variables, and that's why purging is important.
Okay, thank you. So there are essentially three questions left. I can combine two of them. Basically, one comes from a member of the audience who was incidentally a participant in the Adia Labs Causal Discovery Challenge. And he says that the top solution in the challenge featured a self-attention layer in the neural network. Have you seen the attention mechanism widely applied in financial context, particularly in causal factor investing or short-term financial modeling? And just to combine this with the other question is that essentially there is this theme to these questions of the recent advances in that I just mentioned, large language models, other advances, and what are the areas of finance, in particular in the area of the correct, let's say, design of algorithmic trading strategies that will be most impacted by the most recent advances in this world of AI and large language models and transformers.
Excellent. Yes, the tournament that we conducted in the context of causal discovery led to very interesting solutions. There were several approaches that outperformed the overall contribution submissions to the tournament, and in particular approaches that combined multiple technologies and techniques tended to be the most successful. So I don't think that it was particularly that the use of transformers was a key condition for success. I think that it was more the use of ensemble methods, which utilize as part of the methods transformers, but also other architectures and other approaches that tended to perform better. I think that this is probably the right conclusion. The right conclusion is that it is beneficial to use ensemble methods whenever possible. So this is perhaps one of the few free lunches that you get in machine learning, right? In most cases, and we can never say in every case, of course, but in most cases, ensemble methods perform better than the cutting edge or most sophisticated approach. And why is that? Well, for a very simple reason. Ensemble methods allow you to reduce the variance of the models. So it's a very efficient way of avoiding overfitting. And let me be a bit more precise. There are two types of overfitting. There is train set overfitting and test set overfitting. Test set overfitting is what I was referring to before, backtest, right? You run a simulation, look at the performance on the test set, modify your model on the train set, and run multiple times. After a number of cycles, now your model is overfit to the train set. But you can also have test set overfitting. How do you deal with test set overfitting? One very effective approach is ensemble methods. Right? You want to develop a collection of models and combine the forecasts from these many different diverse methods. So this is one of the conclusions that causal discovery tournament, that ensembling also works very well when you apply these technologies to causal discovery. So it's not only something that is useful in forecasting problems, for instance, forecasting returns, but definitely as well when you're trying to derive what is the causal structure in the data generating process.
All right, thank you. And the last question refers back to the analogy you make in the first chapter of the book between alpha discovery and gold extraction. And the question reads as, what does this mean for the structure of the industry? Do you see more consolidation or more medium to small size specialized shops that are propping up?
Wonderful question. What this means is the following. If your mandate is to manage tens of millions of dollars, even hundreds of billions of dollars, you need to set up a laboratory, right? If your mandate is to generate returns at very high scale, very large scale, you need an industrial operation. It's not going to be scalable if what you do is to follow the silo approach. Let's say you have 1,000 portfolio managers and you give a small allocation to each of them. That's going to be very, very expensive and probably not sustainable or scalable at least. Now, from that, we should not reach the conclusion that there are no opportunities left for small operations. That is not the case. I would say that the same argument indicates the opposite, right? The fact that in order to manage large amounts of assets, you need a lab structure, like this sort of industrial assembly line. What it means also is that those structures are not going to look for the small alphas left.
Right.
So those are still there and very much available to small teams. They are not competing for the same opportunities, you see? The funds that are competing for opportunities where you can deploy $1 billion on each are not looking for opportunities where you can make $10,000 a day. Those remain untouched, right? In fact, no large-scale operation would want to allocate resources to exploit those alphas. So in the end, it's like in any ecosystem, right? The fact that there are lions doesn't mean that there could be no lizards. You go out in nature and there is a space for everybody, right? And lions are not competing with lizards. In fact, they have a symbiotic relationship. So that's the correct reading. You should not take from the book that there is only a space going forward for consolidation or very large operations. What it means is that if you want to solve a really hard problem, like managing, let's say, $50 billion, you need a large-scale operation, or even $10 billion, right? But if your goal is to generate returns, let's say, on $100 million, that's a different problem. Now, the question is, are the fundamental problems of investing the same? Yes, they are the same. You still need data structuration, feature analysis, strategy development, backtesting, deployment, portfolio oversight, and so on. You still have the same problems. It's just that in the case of large-scale operations, you need an assembly line approach. If your goal is to extract alpha from a particular data set where the capacity is $10 million, you still have to solve those problems. It's just that you do not need to reach the level of complexity and sophistication that would require for managing, let's say, $10 billion.
Excellent, excellent. Yes, well, which is a wonderful point to end this conversation, because it's a very positive and hopeful point, because I know that majority of readers might think, actually, to the contrary, that, well, there's no hope. But as you said it so nicely, in the ecosystem, there is food for everyone. And probably you're not going to go after the food for the lion. You cannot even digest it. You cannot even, it won't be the right thing for you. And if you're going after that, you have to have the infrastructure which is appropriately designed to handle that. But doesn't mean that there is no food and everybody except lions, starves to death.
Exactly. In fact, let me finalize with this quick thought. The amount of opportunity is growing. It's not decreasing, it's increasing. And there are several reasons for that. Number one, the amount of data sets continues to expand. There are today data sets that were not available before. That means that a lot of the variance that was observed in the markets before and was unpredictable because there were no predictors, now that becomes available. So before, we did not have access to regulatory filings like 10Ks, 10Qs. We didn't have access to satellite images, recordings from investor sessions like earnings, right? We didn't have access to readable news. We didn't have access to sentiment indicators. We didn't have access to geolocation data. We didn't have access to surveys. We didn't have access to Google searches. We didn't have, there are so many data sets, industrial data sets as well. There are so many data sets available today that they were not available 2 years or 5 years ago. So the amount of opportunity is increasing, not because markets are less predictable today than before, but because they are more predictable because there are more data sets. And as a result, that creates even more space for all sorts of players, large players and small players. And as I said before, there is a symbiotic relationship between a small player and large player. Large players create opportunities for small players as well. Because once you know that you can predict better some prices, you're more willing to trade. And as you trade, you create inefficiencies, the trading process, right? There is no perfect way of executing large orders. It creates some opportunities that smaller players can arbitrage. So as a result, I would say that not only there is a space for small players, but there is more space for large and small players as more of these data sets become available.
Mm-hmm. Mm-hmm. Well, wonderful to know. Wonderful to know. All right. Well, thank you so much again for sharing this hour with us. We really appreciate this. All the best to you. It's wonderful to follow you on LinkedIn and see all the successes, all the greatness and glory. And we all wish you all the best going forward. And again, thank you very much. And I will be in touch.
Likewise, it has been a pleasure.
Thank you. Bye.
Take care. Bye.